Okay, the capital acquisition is in the appendix of this chapter, but I do think it's important to understand these functions. Now, I am going to show you in this PowerPoint, the textbook doesn't provide a PowerPoint for it. So I'm going to show you, though, using the financial calculator, because I'm not a fan of using those long formulas that the textbook provides. So really, when we do capital budgeting, we're using our net present value, our internal rate of return, our accounting rate of return, or our payback period. So the financial calculator can do the net present value and the internal rate of return very easily, and again, not using the large formulas. So say we have a machine that costs $120,000. It's going to provide either cost savings or additional revenues to us. Inflows, though, at $35,000 for 5 years, and there's a required rate of return of 12%. So we have to at least make 12% on the deal, or we're not going to want to invest in it. So find our net present value. So if we go to our financial calculators, we can go into our cash flow function, which is the CF button. And then our cash flow for year 0 is what we have to pay today. So notice it's a negative because it's a cash out. So we're giving up $120,000 today. Then we arrow down, and the next field is our cash flow for year 1, which is $35,000. And then we arrow down, and then the frequency is 5. We're going to get that for 5 years. Then we move over to the next button beside it, and that's our net present value button, or our NPV. So we press that, and it'll pop up I equals. We want to put in 12. Now let me go back. When you put in these values, you always have to push the enter key. So don't just arrow down. If you arrow down, it's going to go away. So type in the value, push enter, then arrow down. So type in 12, push enter, arrow down, and compute. And as long as it's a positive number, we would accept it. If it's like, let's say it's exactly 0. If it's exactly 0, then that tells us the project is earning 12%. So we would still accept it. So the only time we reject a project is if we calculate the net present value and it's negative. Okay, then what about the internal rate of return? So if we've got $100,000 that we could invest today in a piece of equipment, and we're going to get an uneven cash flow. So year 1, we're going to get $20,000. Year 2, we're going to get $30,000. Year 3, we get $25,000. Year 4, we get $35,000. Year 5, we get $40,000. Calculate out that internal rate of return. So then we're going to still use our cash flow function, but then now our cash flows for each of those years will be different. So our cash flow for year 1 we'll put in as the negative $100,000. Then again, go back. So your CO1 is going to be 20,000, and then you'd arrow down, and the frequency is just 1. We only get it one time. CO2 is going to be 30,000. Arrow down, your frequency is 1. Your cash flow year 3, or CO3, is going to be 25,000, frequency of 1. CO4 is going to be 35,000, frequency of 1. CO5 is going to be 40,000, frequency of 1. Then we can come over to the IRR button for the internal rate of return and push compute. It gives us a rate. So it's saying, okay, you're going to earn 14.49%. So if our required rate of return was still 12%, we would accept it because we're earning more than that required rate of return. Okay, the payback period is a little bit easier. You don't have to factor in the time value of money. You want to know at what point do you earn back your investment. So if the investment is $90,000, it's going to take year 1, we get $25,000. Year 2, we get $25,000. So we're up to $50,000. Year 3, we're going to get $70,000. Yeah. Okay. So then we're not quite there yet. We got to go a little bit more, but then we need 20,000. So we're going into year 4, but not all the way to the end. So it's actually probably going to be a little over 3.5 years, but we're rounding it off to 3.5 years. Yeah, they showed us. So again, you got to go a little bit further. So it's really like the 3.67 years. Okay, then our accounting rate of return, if we've got a project that costs us $75,000, a life of 5 years with no salvage value, we're expecting revenues to come in at $22,000 a year, less expenses of $5,000 a year. We're going to calculate our accounting income, so the $22,000 minus the $5,000, and then divide that by the initial investment. But we also have to remember depreciation. So depreciation, we take the